everyone, and welcome to this panel on distressed assets. As we've just heard, we're facing an incredibly tough world right now, with borrowers and corporates around the world facing difficult conditions. And this panel will discuss where they see the opportunities, where they see the main headwinds facing the economy. So we've got a panel of financial advisors based in the region, global investors, and we're going to start with the vision from Mubashir, who has 20 years experience in the distressed asset space. What would you say are the key headwinds right now facing the economy that are creating distressed opportunities?
Thanks, Laura. Good afternoon, everyone. To put this into perspective, the opportunity set has exploded and continues to do so. Just to give some statistics, there's about 80 billion euros of debt that's trading north of a 16% yield in Europe. That number is up by a third compared to 6 to 9 months ago. Similar number in the US is about 240 billion, just given the size of the market. And this is just in the secondary market. And what's driving that are 4 factors: rates, inflation, the consumer, and banks retrenching. If we take each one in turn, rates, this is the fastest increase in rates that certainly I've seen in my career. And that's having an impact on businesses' ability to service that debt. Just to give you a statistic, prior to the rates increase, interest as a percentage of EBITDA was less than 20%. Today, it's closer to 40 to 50%. And that's before we take into account issue number 2, which is inflation. Operating costs, CapEx, they've all gone up 30 to 40%, which is again impacting, and businesses' top line have not increased as much. So this is having an impact on businesses' cost structures. And then if you take issue number 3, which is the consumer is struggling. Just to give you some examples of my own, my energy bill's gone up 3x over the last 18 months. My mortgage rate's gone up by 4x, with the result that consumers are buying less. And you're seeing, especially in the chemical sector, that's impacting the end demand for products. And you're seeing destocking, which was last seen at the end of 2008. And then on the banks side, they're retrenching from lending, particularly in the mid-market. So that combination of factors is impacting the supply of distressed and special situations.
Sure, thank you. Let's now turn to Bhagesh. So you are responsible for the fund services business at SS&C. What are your investors saying? What are your clients saying?
SS&C is the world's largest fund administrator. So we're servicing over 3,000 clients, about 3 trillion of assets, with about 7,500 people. So definitely my perspective is a global perspective. We do an annual survey of investors, and I have copies of this for anyone who wants me to send them one. And we do it annually. It's very interesting to compare year after year what's happening. We see investors telling us 251 LPs globally, with a significant number from this region, telling us they want to increase their allocation to alternatives in general. Specifically within that, we see reduced appetite for hedge funds, but an increased appetite for private equity and private credit and debt in particular. So from that perspective, despite the conditions in the market today with inflation and high interest rates, and certainly in some parts of the world, economy slipping, we still see more money coming into this asset class. Combine that with consolidation in the industry amongst investment managers, and I have a number of larger investment managers who are looking to buy firms in this region who specialize in this area. That gives you an indication of the size of the appetite globally. On top of that, I see a growing trend of increased regulation and capital requirements on banks, which will force them to dispose of portfolios of loans. And the appetite to buy them is coming from my clients on the private credit and private equity side.
Thank you.
So overall, I do think the conditions are really good in terms of more capital flowing in. I think my colleagues here are going to talk a little bit about returns, and that's obviously an important factor.
Sure. So before we move to the Middle East specifically, where would you say the key sectors and geographies are for you, Mubashir and Vagesh? What would you tell us, Mubashir?
Sure. So because of the factors that I mentioned, the impact is widespread across a lot of industries, because rates, the cost increase, that's impacting loads of industries. Specifically, we're seeing in the chemical sector, we're seeing for other reasons, the CRE, commercial real estate sector. Geographically, the UK, Germany are really struggling. And the US, whilst the opportunity set has increased, it's not as bad as it is in certain parts of Europe. And that's manifesting itself into situations where companies are just simply not being able to refinance themselves. And that's creating its own opportunities. We will eventually see some of those companies that can't refinance themselves, some will succeed, and others will end up going into restructurings, and they'll have to negotiate with their creditors.
Absolutely. So we've talked about the global picture. Let's now turn to the Middle East, very specific region. Vikas, you've been in the region for quite some years. You've got a good picture of it. What would you say? How would you say this global dynamic is manifesting?
So I think in the Middle East, and I think many of people over here are from Middle East. I think things are quite different. Clearly, so I feel there's a duality. So at one level, there's a fair bit of tailwind coming through because of the surplus that these economies have been having for the last 18 to 24 months, based on the obviously high oil prices, and the surplus is now being invested significantly in infrastructure and a lot of policy changes, etc. The headwinds are probably not as acute necessarily as we mentioned, Mubashir. You've talked to Bhagesh, because but we do have headwinds, and there is a delay, I suspect, because for 15 years, because many of the economies are pegged to the dollar. For 15 years, you've had a very low rate of interest regime, a lot of liquidity in the market, etc. And then, as Mubashir mentioned, things have really ramped up. So we have imported that monetary policy into this market. 15 years, we were seeing a lot of paper being written, at relatively low pricing. A lot of that is going to come to get refinanced, and I think that's kind of where we're going to see that build up of distress coming through. Just data points wise, NPL today in the GCC is sitting at about $50 billion. So clearly not at the size that you've seen, but clearly still significant. And you got to deal with some of that coming up. Now, the one thing good has been that our utility bills haven't really gone triple, which is good news. So that's some positive. So yes, so you can see, it's a good mix of situation, but it's obviously a very dynamic market. And the one other thing I'll just maybe briefly mention is you've also seen in the last 12 to 18 months a number of private credit and special situation funds moved here in ADGM, and a lot of that is also because there's that opportunity that's coming up in the market, that of course these funds are going to lend their expertise and also liquidity into.
We can talk a bit more about that later, but let's first turn to Naveen. Again, you as a financial advisor based in the region, you have a very good understanding of what the key headwinds are, where the key opportunities might be. What are you seeing in the past few months, and what are you expecting?
So I think the macro position of the GCC remains very strong, particularly the UAE and also Saudi Arabia. What we've seen is that it's taken a lot longer than expected for interest rates to really bite and have a fundamental impact on corporates, and the interest rates hasn't been a trigger for restructurings in the region thus far. I think that will likely have a greater impact in time over the course of 2024. Inflation has been more subdued versus Western Europe and in the US, so that hasn't been a trigger either. But we are seeing pockets of stress, but it's very difficult in the Middle East to formulate specific trends. But if we look at the credit markets, what we are seeing on the new money side is that the banks are generally more focused on healthier investment grade credits, and I think it's much tougher for the mid-market to raise financing today. So I think it's going to be a much more difficult dynamic for corporates coming to refinance over the next 12, 18 months, particularly on that mid-market side. I think, again, that does lend a significant opportunity for private credit. What we're seeing as well in Saudi Arabia is a dynamic where the banks are being forced to lend in mass to support Vision 2030. These situations, these projects coming up are generally with recourse from Ministry of Finance or PIF, which helps. But a lot of these structures are not, well, let's say not structured in a way, well, thus far, haven't been structured in a way which has been too palatable for international banks, international lenders. That will likely change. But in any case, with local banks in Saudi Arabia looking and being very focused on these opportunities, I think that's drawing up liquidity for the mid-market. Yeah? We're also seeing in Saudi Arabia the banks having to grow their mortgage books quite significantly. Yeah? What we saw yesterday, we saw Saudi Real Estate Refinance Company issue DCM, which was taken up by local banks. What they were doing is basically buying mortgages from the local banks and then packaging these up and issuing bonds, which are taken up by the local banks, right? Thereby creating some systemic risk. So there are these nuances and particularities of this market which are creating opportunities, but I do think those opportunities are fundamentally quite different to what we're seeing in the rest of the world.
Right, very, very specific to this region. One of the big topics, I guess the key trends every time you talk about distress in the Middle East is non-performing loans. I feel like that's something that's come up quite a bit because there's been some landmark transactions that you alluded to earlier in the year. Maybe because you can tell us a bit more, like, is this like the big opportunity going forward, or what are you seeing in this space?
So I think the opportunity is probably going to come from maybe multiple sources, but two specific ones would be, sectors, right? So if I just maybe focus on that just a little bit. So, Mubashir talked to certain sectors and more systemic across many sectors. I think the problems are going to be more restricted here. So clearly you'll have sectors like chemical, et cetera, which are going to be by the global supply chain, et cetera, impacted here too. But if you look at real estate on the other side, right? I mean, that sector by and large is doing generally all right for the time being. There's a lot of money coming into this market. But if you look at sectors like retail, that's kind of clearly, construction is another sector because of legacy payment type issues. So that's one realm of where this comes from. The other one, going back to Naveen's comment about the mid-sized companies and even some big-sized companies, which have the liquidity cycle tightening, will have to start getting a lot of their non-core assets sold. Much more impetus than I've been here 16 years, but much more impetus than we've seen before. So I think these are some of the areas in which we think in the Middle East some of the opportunities are going to come. I mean, the NPL I mentioned earlier, that is about 2% of the asset book. So it's still in a good place, but it is going to certainly most likely go up. What I think we're finding is, obviously we've heard about, I think we were talking about it even last year, the ADCB NPL book sale, which I think is kind of first of probably a few more coming down the track, simply because capital requirement is going to increase, and you'll automatically see that banks will have to start thinking about how you offload and get liquidity into the system. There's the private credit special sits funds are also coming in. There are many more conversations happening now with the banks to look at specific opportunities or NPL book sales. So I think that's kind of where the trend has started, and I think it's not stopping here. I think it's gonna probably continue.
On the point about investors moving in, you're opening an office, Bhagesh, here. Tell us a bit more about what you see coming up.
Thank you. Yeah, we just opened our office in ADGM, and we see this as a major hub for our business over the next decade. We directly service some of the sovereign wealth funds in the region. We've been based in Dubai for over 20 years, but Abu Dhabi, from a fund servicing perspective, looks more attractive. In the future, our software technology business is still going to be hubbed out of Dubai. But to the point of my colleagues here, look, there's cycles that take place, and we're in a place now where there's a lot of dry powder sitting in these global private equity and private credit funds. The mandates are usually discretionary, and so in the global funds that we tend to service, they have discretion over where to operate and spend that capital. We'd see more of that capital coming into the region. Obviously, my concern there is that the local players have an advantage. They know the market. I think some people will get their fingers burned in the cycle that's going to happen, but to be honest, that's sort of like the way life is, right? And so, I don't see any shortage of capital coming into the region. The market here is still buoyant in terms of the economies compared to Europe and the US, and so it's naturally going to draw more capital. So, and in that process, we see people succeed and some people fail, and it's normal.
Mubashir, what would you say as well as from the investor perspective, like what opportunities are you seeing, or do you think it's something in the long run that will offer in the region?
Yeah, like Prakash, we're setting up our office here. I think it's too early from an opportunity perspective here. Most of the opportunities we're seeing today globally are in Europe and in the US. And I think the region has done a phenomenal job after COVID in terms of keeping the economy very buoyant and attracting talent and capital here. But I do think, in this connected world that we live in, inevitably there may be a slowdown. We're seeing some initial stages of that, few and far between. And typically it's the weaker companies that go first. But eventually, if the cycle hits the region, then we'll see more, and being ready and prepared to work through some of those issues, help these businesses navigate capital structure issues, help them turn around, not only just fix their balance sheet, but also fix their operations. We want to be ready for that.
Sure. Makes sense. And what sort of opportunities, again, could you spell it out, Naveen, for us? Like, what things are you seeing right now that you think could be interesting to people like Bashir and Bhagesh going forward?
Yeah, maybe I start off with what's not particularly interesting, which is, from my perspective, NPLs, because I think this topic is spoken about, ad nausea. But the reality is, when you think about portfolio sales today, I don't think there's realism on valuations at all, right? So we work through with banks and go through, NPLs on a line-by-line basis. But I think as it stands today, on a general basis, we can talk a lot about that ADCB trade, but on a general basis, I don't think there's realism on valuations today of those portfolios. But maybe that changes, and there's specific situations where it may be different. Yeah. But I think this expectation that we'll see a huge wave of NPL portfolio trades in the way we saw it in Italy and Greece, I don't think that's realistic today. When it comes to specific line items, specific names and trading in the secondary, we're seeing a bit more of this, right? Particularly in Saudi Arabia, we're seeing some situations over here. There was one situation over here where there was a trade pre-covenant breach as well, which you rarely see over here. Generally, it's post the payment defaults. Everything in traditional EM style happens much later, post the payment default, right? Or seeing one situation which was actually pre-covenant default as well, 12 months out to a covenant default, but that lender saw it. That's quite interesting, and it shows the increasing maturity of the market, right? But I think there's a lot of talk about the NPL piece, whereas I think the primary bit is extremely interesting over here if you look at the UAE, I think last mile financings in the real estate space and general real estate special sits opportunities remain very interesting. Yeah, buying out promoters, so a JV, for example, where one sponsor wants to buy out another sponsor. These types of acquisition financing situations, where the return profile makes sense, I think is very conducive to private credit. In Saudi Arabia and also here, as we all know, we often see very interesting projects with good quality contracting firms, as an example, with contracts with very strong credit-worthy ministries, AA rated, single A rated ministries, but the receivable days go north of 350, 400 days. I think these types of situations remain extremely interesting from a receivable-based financing perspective, and I don't think we're seeing a lot of that today. But I think that's quite an interesting space. Again, I think acquisition financing, talking to a lot of mid-market private equity over here, I say a lot, that's not a big number, but those that are active over here, they're very vocal about the difficulty of raising acquisition financing. Yeah? In a growth market where that private equity dynamic looks quite interesting from a returns perspective, again, it could make sense from a private credit perspective. So I'm going across the landscape of distressed, stressed, and senior / leverage private credit, but I think it still remains very interesting, given where rates are today. So these are some examples which are quite different to what we see in other markets, but still remain very interesting.
Absolutely. Because would you add anything to that, like other?
Yeah, I think I would just maybe add that, when we're talking to our clients, I think there's one. I think there are a couple of other topics that come up, right, when we're looking at situations. So clearly, one and perennial issues being around information, right? Because the reality is that as you're getting more and more international and more people who've kind of dealt with these situations in different markets coming into this market, many companies are struggling to produce that sort of information. And of course, the other topic has been governance, right? Which is, how do you get proper governance built into these processes and the companies itself? So there are a couple of challenges, and hence there are probably certain sectors which automatically probably don't qualify for private credit, etc., coming into this market in a big way.
Would you, Mubashir or Bhagesh, would you echo that, Bhagesh, this difficulty?
I think the global trend from investors is for more transparency and information and reporting from managers. Managers have a tough time with that. They've been heavily criticized by global investors for not giving them what they need. And I think it's particularly challenging in the space of private credit to produce that information, to normalize the information from the underlying loans and give it back to the global investors. So I don't think this region will be immune. Investors are getting very sophisticated very quickly. And so I think that will be a challenge for managers.
I would just add, I also think we didn't talk about DIP. We haven't spoken about DIP yet, but I think there'll be, we have a few examples, the HG situation, NMC situation. There's some good precedents now of DIP financing and some of the local banks also recognizing it as a concept, right? I think there's more that can be done for people to get more comfortable with DIP financing from a legislative perspective. Also getting the trustees comfortable with the concept. But I think there ought to be more DIP financing opportunities. But again, it comes with the existential question of whether we think we're likely to see more restructurings. Again, I think it's quite difficult forming specific trends over here, but possibly.
Yeah. That's, I guess, one. Maybe Mubashir can talk about this as well. But what are you expecting?
I was just going to add that we've talked about the supply of special sits and how it's increased globally. On the demand side, if I reflect on what you said, Vikas, about the information asymmetry and the kind of just less information, as a global investor, the way that we would calibrate this is we'd take that into consideration. We'd take into consideration, I know there's a panel later on about the jurisdictional and legal aspects of investing. We'd factor those in terms of the expected return that we would want for a situation that, perhaps has, less or worse information in a legal regime which is not as, has less precedent than, for example, in the US or the UK courts. So the return requirements are going to be different. And so the demand for those opportunities is also going to be calibrated. The more opportunities there are globally, that's going to factor into the kind of returns that one should expect for these types of opportunities in the region.
So right now, it's not the most, I guess, as mentioned, it's not the most attractive region, partly because of this, perhaps.
I think there's just fewer opportunities.
Yeah.
Right now there's a combination of just fewer opportunities because the economy is a lot more buoyant, and there's just a lot more opportunities elsewhere. So people's eyesight is focused elsewhere, and that may change depending on what happens to the economy in quarters to come.
And beyond the economics, I guess there's also like something in the ecosystem or some things that could be done, right, to encourage the ecosystem to develop. Naveen, you've spoken about this before in terms of like maybe primary or secondary opportunities in the distress space.
For special situations on the primary side, I think once the banks become less receptive to kicking the can down the road via amend and extends or refinancing at skinny margins, once that dynamic ends, then it'll be more conducive to a primary left-fin / special sits market potentially. On the secondary side, I think having a more standardized dynamic to assignments, transfers, right? Even maybe going beyond the LMA template and having banks, trustees, judges buy into that such that people do feel comfortable that if they're buying in the secondary, it's going to be recognized in a court process. That's going to help. DIP, similar sort of theme, once it becomes enshrined in a legislative manner into the insolvency law and people are comfortable with how that works. I think once that's done, that's going to be much more conducive and supportive to more DIP financing. I think what Ministry of Finance are doing over here in bringing consultants, advisors, lawyers into a room and brainstorming what the new insolvency regime would look like, I think that's really helpful, getting the perspective of market participants and ensuring that there's a healthy secondary market is one of the many themes to make sure that works well. So I think that's another important point. So it's a bit about the legislative piece. It's a bit about connecting the dots in the ecosystem between Ministry of Finance, bankruptcy commissions, and market participants as well, which I think is working quite well over here, actually.
Mm-hmm. Because would you want to comment on that?
No, I think I just want to add that I think with more and more players establishing,
Sure.
both of yourselves establishing presence on the ground, I think that's going to help also because many times, going back to Naveen and just adding that, these forums are extremely important here and let's say in a market like Saudi, because I think a number of things will have to change, right? It's not going to be just one or two levers. A lot of documentation type, regulatory type stuff will have to change around to create that ecosystem. So the more voices can be in that conversation, the better the outcome is going to be. I think that's what we're finding, is kind of now maturing.
Sure.
I think price discovery is important, right? So having the funds here, having our broker friends here as well, talking to the banks and getting a sense of what's realistic from a price perspective, that's quite helpful.
From an external perspective, what I can see is there are a lot of strides being made to create that ecosystem, to bring the restructuring law firms here to host a session like this. All of that is very helpful to build that ecosystem, to facilitate more of those restructurings, more of the turnarounds. So, if if the economy does turn and you do have more of those types of situations, the ecosystem will be here to deal with them, which is, I think, a very, very good step that's being taken.
Rakesh, what would you also add to this conversation? How can we expand? What would investors do?
Look, what I see coming here to Abu Dhabi several times now is very sophisticated setup. I think it's a setup that would give confidence to investors and to managers coming in. Represented by my colleagues here, the expertise is here in the region. That's a foundational step that investors will be looking for. So I don't really see a lot stopping the growth of this asset class in this region, private equity in general. I would say, I think the macro challenges have been touched on, investors getting nervous about valuations in general, and investors getting a little bit nervous about the growth of these continuation funds, right? And so hopefully that bubble gets burst at some point, and there are real exits that happen.
Sure. Thank you. Well, we're close to time, but I think we've got time for one or two questions. If there's anyone with hand up, is there a mic that we can get to?
You're ready.
Yeah.
Good question.
Do you want to start with that?
There are opportunities. They're just not as many. And what you will typically see in a cycle is the US will go first, Europe will come second, and then the rest of the world will follow. So unless this cycle is different, that's what we're expecting. And whilst there still are opportunities, companies get into trouble irrespective of the market environment, be it because of mismanagement, over leverage, technological change, regulatory change, and that happens irrespective. So there are opportunities. It's just not as many as we're seeing in the US or Europe yet. And that's the operative word.
So just maybe if I'll give you my dimension on I think the two sectors in my mind are side dealing, right? So real estate is booming for all the factors that I think we know about, right? There's a lot of money coming to the region. In fact, I think these regions have probably been net importer of talent, right? I mean, just globally, if you think about the populations that we've seen increase, I think that's kind of quite an outlier. Construction, on the other hand, has very different dynamics, right? And construction is not only for residential units or any of that. That's a much bigger spend. But also that competition is just not local contractors, right? They also have international contractors coming in. But also don't forget that, there are many more cycles that sector has gone through. And in my mind, many of the players in that participants have been still dealing with some of the challenges from the previous cycle. So there's some legacy payment type issues, etc. Margins are thin. Variation orders are a bit of an issue. There's increased competition and so on. So I think the two sectors in my mind have a different dynamic. I don't know if you had anything else you wanted to add.
No, I agree. Contracting has its specific nuances. I think the extent of the receivable days here has always been a problem. So that working capital dynamic has often been the trigger for restructurings over here. And then general cost overrun, some mismatching, but that's not always the case. I think receivables generally is what we see as the trigger. Real estate continues to perform well, but what I was referring to in the real estate space was specifically in relation to last mile financings, where say you've got a sponsor who's built something 3/4 and you need the remainder finished off, but they've done a runner or something like that.
Well, on that note, I think we're out of time. Thanks so much to the panel for a really insightful discussion, and thank you all for listening. A round of applause for.
Thank you.